Are you guys tired of going long, getting stopped out, then going short, getting stopped out, and so on and so forth? It becomes a vicious cycle of losing money. Don't feed into the panic, and you do that by not chasing each and every candlestick. Rather, have a better and thorough plan than that, and I'll explain how. You have to allow the trade to work out by seeing it through. It's not always going to work, but it won't matter because you will still be profitable if you implement sound risk management by trusting your stop loss and letting the trade play out. And I have two indicators that will massively assist with that. I've been using this strategy to become a profitable trader long term, and it's worked out very well for me. Indicators won't always have the perfect setup because they're not meant to exclusively replace price action. However, combining these two indicators and creating a confluence emphatically increases your chances of a successful trade. And those two indicators I use are Fibonacci retracements and two moving averages to help me establish which way the trend is moving, where my price target is, and most importantly where my stop loss is. So without further ado, let's get started. So what you see here is a 30-minute chart of the S&P 500 futures. I use 30-minute candlesticks to draw out my Fibonacci retracements because they end up being infinitely more reliable on the longer time frames. But we're going to use this time frame to help assist with our entries on the shorter time frame, which is the 5-minute chart. But we'll get to that in a second. Back to Fibonacci retracements. Again, this indicator is supposed to be used as a guidance and not some magical tool that's going to give you a 100% win rate. And that's okay because combining this tool with the moving averages, which I'll get to in a second, will dramatically increase our chances of a successful trade every time. But before we begin with all that, let's switch over to the 180-day 4-hour chart. And by looking at an even longer time frame, it's really going to help us establish where the trend may be going for that particular day. So ignore these last two candlesticks, which basically represented the last trading day on Friday, because we're going to pretend we're preparing for our Friday session in the pre-market morning right before the market opens up at 9:30 a.m. Eastern Time. And this will help illustrate my point. So going back to the Fibonacci retracements, we always draw it from a high to a low. And in this case, I'm drawing it from here to here because at the time this is where our low was, and you can see the candlesticks bounced almost perfectly from the 78.6% retracement, and the days following it reached the 23.6% retracement, which is our first price target whenever it bounces off either the 78.6, 61.8 or 50% retracements, which are these three lines right here. Now remember when I said to ignore these last two candlesticks because we're going to pretend to transport ourselves back to Friday morning session. So the last completed candlestick we'd be looking at is this one right here, which closed right above the 23.6% retracement. So based on this pattern setup and the fact we reached our price target, I instinctually expect a bounce to come at least partially to the next retracement, which would be this 0% right here. And I'm going to get rid of this to make it look cleaner. So now if we go back to the 30-minute chart, I'm going to once again draw a Fibonacci from a low to a high. Again, I draw it to this high because I'm putting myself in a time right before the market opens up at 9:30 a.m. and at that specific time this was the high, and I can already see as we inch closer to market open we've already bounced off the 78.6% retracement perfectly, further validating the move to the 23.6% price target. But we don't want to simply jump in because we want more confirmation than that. Additionally, we want to establish a great entry so we know where to set our stop loss, and we do that by switching over to the 5-minute chart. So I usually don't jump in at the opening bell. I usually let it play out for the first 10-15 minutes and start trading around 9:45 a.m. Either way, let's say I did trade the opening bell. The goal would be to get into an entry in which the 13 EMA, which is this gold line right here, is above the 20 EMA, which is this blue line right here. And I wait for the candlestick to bounce off the 20 EMA. Once I've confirmed the bounce, I look for an entry anywhere around here, and my stop would basically be if the candlestick breaks below this 20 EMA. So basically once this candlestick is completed, my stop loss is a low of that said candlestick. and my price target would be the 23.6% retracement that we would establish from the 30-minute chart from earlier. So if we play this out on Friday, you could see we ran up a little, but then we would have eventually gotten stopped out. And again, that's okay, because one of the key things I highlighted in order to be profitable long term is sound risk management. You have to learn to cut off your losers quickly and not bag hold them. That's how people end up losing a lot of money. So getting back to this example, our bias is still bullish just based on our Fibonacci, and you can see right here we made a higher low and this time bounced off the 61.8% retracement. So now we wait for the 13 EMA line to get above the 20 EMA line again. Once that happens, we wait for a candlestick to bounce off that 20 EMA, and you can see with this candlestick we got both those requirements right here. So an entry somewhere in this candlestick would have been a great entry, and you basically just follow along until it reaches your 23.6% price target while establishing the low of this candlestick as your tight stop loss. And you could see it never hit it this time, which is great, and we reached our price target, thus making it a successful trade. And that's all there is to it. And the strategy would work with shorting as well. Just make sure the 13 EMA is below the 20 EMA this time, and make sure you have your 30-minute Fibonacci established from a high to a low instead of a low to a high. But I really hope this was helpful, guys. If you have any questions, please leave them down in the comments below. Please, if you found this video useful, all I ask is you hit the like button. It'll really help with the outreach of this video and more importantly this channel. So that'll do it for this video. I'll see you guys in the next one. Good luck in the markets and take care. Peace.